we hear a lot about multi-asset fund in these days, where they invest in equity, debt, and sometime even maybe in commodity, right?
That's right.
Commodity, maybe gold or silver, right? How this fund can be placed into an investor's portfolio? Few questions around that is, what should be return expectation of the customer? Whether we should be treated them as an equity return, or we should treat this as a hedge in the portfolio, because definitely this asset class will give you better returns than debt, right? So how exactly that mind frame to add this particular product into the customer's portfolio?
Sridhar, there are two ways to construct individual portfolio.
Okay.
Either you suggest an asset allocation, let's say it is 70, 20, 10 in favor of equity, debt and commodities, for example.
Yeah.
Then for the proportion of 70, 20 and 10, you will select different funds and give it to the investor as one individual portfolio.
Okay.
Right? That can also work. But the only difference there is somebody has to help that person to understand what is the right asset allocation and which are the funds to invest into. And each fund comes with a different taxation, because each fund is a different in asset class. Equity comes with equity taxation and the other funds come with other taxation.
Okay.
Right? That's how it works.
Okay.
There is also another easier way to do the same thing. Rather than deciding yourself on what is the allocation, you give that money to the portfolio manager. The fund house and the portfolio manager will decide based on the valuations where should be one investing, whether it should be dominated by equity, fixed income, in what level, whether it goes into commodities. All these decisions will be taken by the portfolio manager. And in many cases, there is also an arbitrage component, and those funds actually, while they invest in short term, they invest in arbitrage. Ultimately, you get equity taxation for the full 100% of your money. So the advantage is, one, you can have one single fund in your portfolio
which covers all three,
which covers all investments of equity, fixed income, commodities as well. And also in many cases it can come with equity taxation. So while you have invested in fixed income and commodities, because the fund is an equity fund, the overall taxation could be equity taxation, which is generally better compared to fixed income or commodities. So that's the advantage of looking at these kind of funds. But obviously there are various subcategories in that. Maybe you can educate
your... So Kotak has a multi-asset fund?
Sorry?
Kotak has a...
Yes, we do have multi-asset allocation funds. We do have balance advantage funds. We do have equity savings, which comes with a lower equity allocation.
One question around this equity savings fund. So equity savings fund we should place where? Above... after arbitrage, maybe, or 2 years?
It will be after arbitrage, because there will always be open equity position. In arbitrage, there is no open equity position. It's always completely hedged. So it's not dependent on where the equity markets are headed. You get a reasonably secure set of returns over a period of time. But in case of equity savings, generally there is some open equity or directional equity in the portfolio. So to that extent, the risk levels are slightly higher than arbitrage. And hopefully, if that equity works well, it should also give better returns than arbitrage.
So an investor who is whose time horizon for that particular amount in his portfolio, say 2 to 3 years time horizon, can we consider equity savings fund in place of arbitrage? Is it really make sense? Assuming that he is a 35% tax bracket guy, debt may not be that encouraging. So can we put a portion of his that 2 to 3 years money in equity savings fund? Is it possible?
Yes, I would say closer to 3 years is at least the minimum holding period. But yes, those kind of investors can look at equity savings category and take little bit of equity risk and also get the benefit of equity taxation.
Correct. Anyway, if things are not good, he may have to just postpone his withdrawal maybe few quarters or half a year.
That's correct. And usually in all of these hybrid funds, whether it is equity savings, multi-asset allocation or balance advantage category, the valuation is always looked at by the portfolio manager to decide the investments into each of these asset classes. So in a way, when the valuations are expensive, the asset class comes down in terms of exposure. When the valuations are attractive, the exposure is built in those particular asset classes. So that's how it works. So generally it may not work similar to equity fund. It may not capture the entire upside, but at the same time the downside is also protected. So it gives you a lot smoother kind of return expectations as compared to a pure equity fund. The volatility is much lesser. The returns may not be as superior as equity, but that's not what you are trying to get here. You are trying to get a diversified entry into market, and that's what it provides.
When you are mentioning about this balance advantage fund, this balance advantage fund which we discussed in our previous videos, this is one separate asset class which is really good for the people who really don't want to play 100% equity, but they need a better return than a traditional product, and they really don't need that money in next 4-5 years kind of that. There is a decent appetite there, but there is miles to go. If we see the fixed deposit size of this country vis-a-vis capital market, I think SBI boss is telling if market falls, money may come back to bank. There's a separate discussion, we should not talk here. So, but there is a huge appetite, there's a scope for sizable money to come to this balance advantage fund. You also have a balance advantage fund, right? So how exactly is the portfolio construct? In a scenario like today, 82,000 Sensex and price earning multiples around 23, 24. So your equity allocation is less. Can you throw a little bit more light on this? Because there is a huge scope for investors to earn little better return for their long-term good.
Yeah, in our balance advantage fund, we move equity between 20% to 80%. 20% at the minimum, 80% at the maximum.
Okay.
And currently we are at around the middle level of about 50%.
Okay.
So that's in directional equity, which is open equity.
Open equity.
And about 15% plus is in arbitrage. So net, the equity allocation is more than 65%. So it gets equity taxation benefit. And the rest has gone into
debt,
fixed income. So that's the current asset allocation. Obviously, it changes based on the valuations. If valuations move up, the equity allocation may go down towards 20. And if valuations improve, it becomes more attractive, favorable, then probably we'll move towards 80%. So that's how it works. So it will keep allocating based on the valuations and moving between 20% and 80% equity. Equity is the primary determinant. And once the equity allocation is fixed, then the arbitrage and fixed income allocations are decided. That's how it works.
And under equity, you have just highlighted previously, just for the benefit of our customers, under equity also you are not with today's those stocks which are with the high PE multiples or something like that, right? So in case if there is a...
Yes, it is like any other portfolio. Okay. Even if it is a 100% equity fund, we keep reviewing the portfolio, we keep deciding on where to be remain invested, where to make fresh investments, where to book profits, etc. So same thing happens even in this fund, just that the equity is not the 100% allocation, equity is less than 100%. So that's only different.
Okay.
And also it increases or decreases allocation based on valuations.
So one more thing what I have seen, because I generally track Kotak Balance Advantage Fund, where when I saw the monthly NAV, February 2020, then that March, April, May, that index came from 41,000 to 27,000 level. For 2 months it came down, or 3 months it came down. Then it's actually started going back. And when we see that Sensex fall of 41,000 to 27, around 38-40% kind of that correction, vis-a-vis this NAV correction, it exactly tells and it guarantees us also that if you have a sizable wealth where you don't want to play 100% equity, this asset class will give you a pretty decent return.
That's right, because it's never 100% into equity. So even in case of market fall, it doesn't fall as much as equity funds.
35% debt anyway is there.
And as valuations move up, you would always reduce your equity. So you will never have the situation where you are at 80% in terms of your equity allocation if the valuations are expensive.
Okay.
If the valuations are expensive, you would be more towards that 20% range. So to that extent, it takes care of your downside volatility.
Okay.
And upside is also capped. That's a trade-off that you make.
Correct.
You won't get the full upside, but you don't lose
money
as much as equity funds in case of a correction.
Correction.
So it's a good product with a lot lesser volatility as compared to a pure equity product. And I think those who are new to equity investing should actually experience the hybrid category first, and then decide to come on full equity. If they are unsure about how equities are going to work, unsure about market volatility, etc., it would be better to experience that through starting with, let's say, equity savings category, moving to a balance advantage, maybe moving to multi-assets, and then finally coming to full equity category.
One particular small point on this balance advantage fund, this 35% debt portion. today anyway looks like interest rate will come down, that bond price inversely proportion to each other, it is going to give the good upside to the investors. Say take an example when interest rate is going up scenario, because it is inversely proportion, at that time how you handle your debt
then
allocation?
it will go into only short-term investments in fixed income. So just like how we take valuation into account, we also take interest rate risk in fixed income investments and construct the portfolio accordingly.
So there also risk, you are taking the full care of that.
Yes, that's right.